Good morning everybody. Today we are going to move ahead with the last part of the specific cost of capital, okay, that is cost of retained earnings, which is represented by KR. Okay, cost of retained earnings is also called as KR. Okay, as we have KD for cost of debt, we have KP for cost of preference, KE for cost of equity. In the similar way, we have KR for cost of retained earnings. Okay, before going ahead, let us understand what is this retained earnings. Okay, retained earnings are the earnings which are retained by the company from the profits for future contingencies, or in simple words, it is the amount of profit which is kept aside every year as reserves to meet the future contingencies or future prospects, future investments. Okay, that is called as cost retained earnings. So actually if you see, there is no cost incurred on it, because it is the profit from which this amount has been taken out as reserves or retained earnings. Okay, so there is no cost, but actually there is a cost involved, which is called as the opportunity cost. It is called as the opportunity cost. Now what is the opportunity? What is, if you have understood opportunity cost in economics, it is the cost of foregone opportunity. Now what is that foregone opportunity? Suppose that earnings which was retained, that profit which was retained, okay, was given to the equity shareholders as dividend. Instead of retaining it, instead of keeping it as reserves, it was distributed among the equity shareholders. Let us assume that the shareholders would have invested it somewhere and they would have got returns on that investment. So if you are retaining money, that means you are not giving that money to the shareholders, and shareholders are not able to invest it outside, and they are not getting that returns. So that returns which they are not getting is a foregone opportunity, which is an indirect cost of opportunity cost to the company itself. Because if you retain money now, in the next year the shareholders would expect more returns, because in the previous year the amount of dividend was less, it was retained. So it is the cost of foregone opportunity. So when I say it's a cost of foregone opportunity and it is related to equity shares, so it is related to cost of equity. So what is the formula for KR, or cost of retained earnings? It's very simple. It is cost of equity, that is KE, into 1 minus B into 1 minus T. It's small t. Okay, please understand the difference here. In cost of debt, where we calculated cost of debt, if you remember, we have used 1 minus capital T. Okay, that was the corporate tax. Excuse me. But in this particular case, we are using a small t, which is individual tax. Okay, so let me repeat the formula. Cost of retained earnings is cost of equity into 1 minus B into 1 minus T. And we always know 1 minus T, or 1 minus anything, is after that value. Okay, that is 1 minus B is, first of all, B is the brokerage rate. So 1 minus B is after brokerage, and 1 minus T is after individual tax. So it is 1 minus B into 1 minus T. What does this means? Again, I'll just throw a light on this 1 minus B and 1 minus T. Okay. So if you remember, if you understand, when the dividends are paid to the equity shareholders, okay, dividend is taxable income. So first the tax is deducted, whatever tax bracket they come into, that tax is deducted, and so you get after tax dividends. And whenever you, whatever amount remains after deducting the tax, you invest it. When you are investing it, you have to pay brokerage, so brokerage amount is also deducted, and the net amount after deducting tax and brokerage is what you are investing. So what are you investing? You are investing the amount of cost of equity, that is the dividend that you are receiving after tax and after brokerage, and that is the reason why we have K into 1 minus B into 1 minus T. So KE is cost of equity, B is the brokerage rate, and small t represents the individual tax rate applicable to the investors. Okay, so let's take a very simple problem on cost of retained earnings. Okay, suppose a company has a cost of equity of 15%. So KE is directly been given to us, that is 15%. Okay, then individual tax rate is 20%, and it plans to retain the profits. That means it is retaining the profits. okay, a brokerage is 5% given, okay, as reserves. Calculate cost of retained earnings. So I'll just repeat what is given in the problem. First of all, cost of equity is given, brokerage rate is given at 5%, tax rate, individual tax rate is 20%. You have to calculate cost of retained earnings. So all the data is given, we have to just substitute the values in the formula. What is the formula? KR is equal to KE into 1 minus B into 1 minus T. So KE is already given to us, that is your cost of equity 15%, that is 0.15, into 1 minus B. B is brokerage, which is 5%. So 5 plus 1 minus 0.5, and tax rate is, individual tax rate is 20%, so 0.2. So how do you simplify this? First 1 minus B, that is 1 minus 0.05 is 0.95. So KE is 0.15, sorry, okay, 0.15 into 1 minus 0.05 is 0.95 into 1 minus 0.20 is 0.80. So if you multiply all these things, you get 0.114 or 11.4%. So what is this 11.4%? That is your cost of retained earnings. I hope you're clear with this calculation of specific cost of retained earnings. So with this, we complete the specific cost, that is the individual cost, that is cost of debt, cost of preference, cost of equity, and cost of retained earnings. Next is the most important thing, and which comes in the question paper for 10 marks. Okay, there would be a sure shot question on the next part, that is weighted average cost of capital. So let's try to understand these weighted average cost of how it is calculated and what types of problem come in the paper. Okay, so yes, so let's start with the calculation of cost of weighted average cost of capital. So calculation of weighted average cost of capital, or it is also called as the overall cost of capital. So before starting with the problem, I'll just give you a brief idea of what this is. Okay, now if you understand, any company will not depend on only one source of capital. Okay, it depends on multiple sources of capital. Okay, like it may depend on debt equity, it may depend on equity preference debt, all the three, or it may depend on debt equity preference as well as retained earnings. So we cannot surely say that a company will depend only on one particular source of capital. It uses multiple sources of capital to collect its money to run the business. So when you talk about multiple sources of capital, your specific cost does not hold good, because it talks about only one particular source of capital, whereas the company is using n number of sources. So when the company is using multiple sources of capital, we cannot just calculate the specific cost, but we have to go ahead to calculate something called as weighted average cost of capital, or in other words, it is called as the overall cost of capital. I hope you are clear with the concept of this weighted average cost of capital. Though you might have studied averages in statistics, like simple average and weighted average. So this is nothing but weighted average of the capital, of the various sources of capital. Okay, so let's go ahead with a problem and try to understand how do we solve it. Okay, very simple, it's not at all complicated, just follow the steps, that's it. Okay, a company has following capital structure. So capital structure is a combination of various sources of capital, so that is called as capital structure. What does this company has? It has 16% debentures of rupees 3 lakh, it has 14% preference of 2 lakhs, and it has equity share capital of 5 lakh. So how many sources are there? Yes, there are totally 3 sources, that is debentures, preference and equity. There are 3 sources of capital. What is the total capital? Total capital is 10 lakh, that is 3 lakhs of debt, 2 lakhs of preference, and 5 lakhs of equity. So 3 plus 2 is 5, 5 plus 5 is 10 lakhs. Now, what is the 16%? Yes, we already know 16% represents the rate of interest on debentures, whereas 14% represents rate of dividend on preference capital. Okay, let's move ahead. What all things are given? If cost of equity is 17%, that means your KE is already given to you, and tax rate is 50%. What is this tax now? It is the corporate tax, that is T, the capital T. Okay, calculate the overall cost of capital, or WACC. I hope you are clear with the question first of all. Okay, so this is your question. Let us now understand how do we solve it. Okay, always remember this particular table. You have to follow this table for all the problems. There are totally 5 columns that you have to prepare. First column is the serial number. Okay, second column is the source of capital, third is the amount of capital, okay, fourth is the specific cost, and total cost. Now what are this? First is serial number. So serial number basically depends on how many sources are there. So in this case there are 3 sources: debentures, preference, and equity. So there is 1, 2, and 3. That is 1 for debentures, preference, and equity. The second column talks about the source of capital. So we have to write down all the sources of capital. Okay, so how many sources are there? Again, I'll just draw these lines for bifurcation. Okay, so how many sources of capital are there? There are 3 sources of capital, that is debentures, preference, and equity. Then we have to write the amount of capital. Now what is the amount of capital? It's already given here. Debentures is 3 lakh, so 3 lakh. Preference is 2 lakh, so 2 lakh preference, and equity is 5 lakh, so 5 lakh of equity. Total of the amount of capital is 10 lakhs. Now going ahead with the specific cost. Specific costs are nothing but your KD, KP, and KE for the individual sources. That is debentures is KD, preference is KP, and equity is KE. Okay, those are called as the specific cost. So first of all, specific cost. Now how do we calculate the specific cost? We know the formulas. For KD there are 2 formulas, that is KD is equal to R into 1 minus T, or KD is equal to I divided by NP into 1 minus T, or there is another formula for redeemable debentures. In the similar way, we have specific cost formulas for KP and KE also. Okay, so using those formulas we have to calculate the specific cost. Now first let us go ahead with cost of debt. Now they have just given 16% debentures and tax rate is given. Have they mentioned anything about redeemable or maturity and all those things, or issued at premium and discount? No. That means they are just irredeemable debentures which are issued at par. Means we can directly use this simple formula, that is R into 1 minus T. So R represents the rate of interest. So what is the rate of interest? Rate of interest is given over here, that is 16%. So R is 16%, that is 0.16 into 1 minus T. Tax rate is already given over here. So into 1 minus 0.5. So 1 minus 0.5 is 0.5. So 0.16 into 0.5 gives you 0.08 or 8%. So what is your cost of debt? Your cost of debt is 8%. So 8% is nothing but 0.08. That is what we take over here. That is specific cost of debt. Coming to the next one, we have the specific cost of preference. So again, they have not given maturity, they have not given par, premium, discount. So it is nothing but it is a irredeemable preference capital issued at par. So the formula is KP is equal to, by mistake, okay, it has become I, it should be D. Okay, so KP is equal to D divided by NP. Okay, so D is nothing but the dividend. So how do you calculate dividend? We have already discussed that. It is 14% on 2 lakhs. Correct? 14% on 2 lakhs is 28,000. So dividend becomes 28,000. And your net proceedings, they are issued at par. That means your net proceedings would be 2 lakh. So 28,000 divided by 2 lakh gives you 0.14. That is 14%. So the specific cost of preference is 0.14, which is mentioned over here. I hope you're clear with this 0.8, 8%, that is 0.08 and 14%. This is your KD and KP. Now coming to the last one, last source, that is equity. Now for equity, if you see, cost of equity is 17%. That means cost of KE is already given to you. So we need not calculate KE at all. So whatever is the KE given, 17%, that we have to use directly over here. 17% is nothing but 0.17. So I hope you're clear with this calculation of specific cost using the formulas that we have already studied in the previous videos. Now let us go ahead with the last column. The last column speaks about the total cost. Now how do we calculate total cost? It is amount of capital into specific cost. So 3 lakh into 0.8 is 24,000, 2 lakh into 0.14 is 28,000, and 5 lakh into 0.17 is 85,000. So it is amount of capital into the specific cost will give you total cost. Okay, so 3 lakh into 0.08 is 24,000, 2 lakh into 0.14 is 28,000, and 5 lakh into 0.17 is 85,000. Now once you calculate the total cost, once the total cost is calculated, okay, you have to take the summation of the total cost. So summation of the total cost would be 24,000 plus 28,000 plus 85,000 is 1,37,000 is your summation of total cost. Okay, I'll just repeat the calculation first, repeat the table. First you have to take the serial numbers depending on how many sources are there, then sources of capital, you have to write all the sources which are available, then the respective amounts of capital have to be mentioned besides the sources, and then we have to calculate the specific cost and write down the specific cost of all the sources. Once we do this, then we have to multiply the amount of capital into specific cost to get the total cost. Once we get the total cost, we have to take the sum of the total cost, that is the summation of total cost, and we have to also calculate the summation of total amount of capital. Then what is the formula for WACC? The formula is very simple: summation of total cost divided by total amount of capital. Summation of total cost divided by total amount of capital will give you weighted average cost of capital, or KO. So what is the summation of total cost? It is 1,37,000 divided by 10 lakhs, which is your total amount of capital. So 1,37,000 divided by 10 lakhs gives you 0.137 or 13.7%. So what is this 13.7%? 13.7% is the overall cost of capital of this particular company, or it is the weighted average cost of capital of the company. This is also regarded as the minimum required rate of return on investment. Okay, so I hope you are clear with this entire calculation of weighted average cost of capital. Just remember this table. This table will help you in solving any problem that you come across, and this particular formula. I hope you are clear with this concept of weighted average cost of capital. In the next videos, we'll try to solve some more different types of problems on weighted average cost of capital. Thank you.